Hey, everybody, welcome back to the Capital Mindset Show. We're here for another live, and today we're just going to be discussing exactly what the title of this live is, which is, talking about the week ahead and what to kind of expect, or at least what I'm expecting, and how that's kind of shaping my strategy going forward. So, I've already receiving some questions here, and I'll start with those just briefly because, again, I just want to talk a little bit about the topics of today. So thoughts on position on Google, and 7% of portfolio. I can't make a comment about that personally because that would be, some individualized advice. But I'm going to be probably thinking about starting buying some more Google. Perhaps let's see how it pans out. But I'm not opposed to adding more Google. I saw that Sven Carlin made a Google video. I don't know what that's all about. Maybe it's positive. Maybe it's not that positive. Who knows? And I did see that a question about Lumen. My only one quick comment about Lumen is I took a quick glance. I'd be a little bit cautious about that one. That one kind of looks like a classic yield trap. So I'd be cautious. Do tons of research. Really be sure with the evaluation that you've created. I think it appears like it could be like a little bit of a long shot, but of course it could work out. And then another question from George. George, hi Fabio. Do you buy into the notion that inflation has peaked? Personally, I don't see that happening around me. Geez, I mean, projections on inflation are really, really difficult. Really difficult. So to be honest, as far as inflation goes with looking at supply chains, I don't think so. I think that there's still room to run. I think that the acceleration can change a little bit to the downside, but not so much that we're going to return to previous levels, if that's what you mean. I think that maybe the acceleration might change. That's one symptom that we could see from something like a liquidity crunch. Usually how I've been addressing it is focusing and trying to highlight the consumer and how that might affect consumer spending over longer periods of time. Well, medium to longer periods of time. But yeah. This, yeah, I'll resize the bracelet. Don't worry. He's talking about this one right here. So this one's an older bracelet, and yeah, my wrist has grown, so it is where it is. Okay, so let's see. But yeah, basically how it's kind of, I'm going to be doing an update video, I think like around this week on my portfolio. It's already is up to date as of Friday. But I'm going to do a more dedicated update video for the portfolio in sometime this week. There is a video being uploaded right now on Palantir. So that one, you guys should be able to see that today once it's done being uploaded. I basically did similar format to that of Honest Company, which I received feedback. And so I adjusted to it a little bit. So I do a little bit more commentary during the earnings call presentation. Of course, there's going to be chapters and stuff, so you don't have to listen to the earnings call presentation. And then my thoughts are towards the end of the video because I've been getting some, again, positive feedback, a little bit constructive criticism on things that can improve upon. I also give like you a preliminary thoughts on what I think about the company beforehand. Something like I will be doing this on companies I am invested in the future. So when they have an earnings report, like a big one, like let's say Alphabet, which is a big holding in the portfolio, I'll be doing like a earnings call reaction, so to speak. Now, I do see there are some other questions regarding Walgreens. I see this. I'm not trying to skip over anyone's question, but I did see this. My eyes just went right to it. Thoughts on Walgreens selling a portion of AmerisourceBergen. So if you guys look back at the old Walgreens video I did on Capital Mindset, it's really old at this point. I do mention that one of the things I liked about Walgreens at the time, and I don't hold Walgreens anymore, it was one of the stocks I sold. And hindsight was good. It was a good time to kind of liquidate at the time I did. But one of the things I liked about it was the ownership that it acquired through ABC, through its dealings with ABC. When I say ABC, that's the ticker symbol of AmerisourceBergen. And as you can see there, that's what the Dark Knight has actually indicated there, ABC. So they owned, I think it was 30-something%, and they just reduced it to 20-something%, like 25%. Off the top of my head, I don't have it in front of me, but I'm pretty sure it's around there. And so with that being said, how does that affect the company? Well, I don't think it really detracts too much from Walgreens. I think Walgreens probably wanted to take some profits off the table. They wanted to realize those profits. And if you actually look at AmerisourceBergen, similarly to the times I was acquiring Cardinal Health, you can see the trajectory of these kinds of companies has been going in a very positive direction. Cardinal Health has been a very good performer within the portfolio, while the rest of the market's kind of been underperforming. So it was good. And I see some, okay, I'm going to go back up because I don't want to skip over anyone's questions, but comments about Open Door. I would be cautious on something like Open Door. That's just my comments on it. But yes, I would be a little bit cautious on Open Door regarding remember the environment that we're in, and I would remember and highlight the environment we're in and try to figure out how that might play out. Something like Open Door. You don't like how I hated Zillow when I didn't own Zillow. I made comments about hating Zillow's business in terms of what they were doing in the home buying, the iBuying segment. I hate that business model. And if you ask me, then therefore I probably won't like Open Door whatsoever. So then I'm definitely not the one to ask about Open Door, because I'm already going to come from that approach that I don't like that business model in the first place. So it's really from there. That's, that's all I can say. I see you guys are talking about gas prices. So yeah, the gas prices, I mean, that's been a decent, I mean, I've lowered the exposure of the portfolio to gas, taking those profits. And I mean, that's already public at this point. We've talked about that over and over and over again. But yeah, I think that the thesis has played out well. And here's a question from Ollie T. When is the video with Rob the Pop Investor coming out? Well, I think he's a busy guy, and I mean, it doesn't matter. If at the end of the day, he is the larger channel, so he might not decide to do a video with me, and that's completely fine. He hasn't responded back to the most recent email, and so I'm kind of just, we're not in a desperate position on Capital Mindset. But if he doesn't respond in due time, I will do my own Warner Bros. Discovery video, because I know that people are waiting on that, and I actually want to do one on it. I'm waiting. I really want to. Okay, so Shaketch's nice job lowering Netflix. Yes, so if you've noticed, actually, if you go check out the portfolio now, you can see actually that the cost basis on Netflix is lowered, and you probably can see that the weighting in the portfolio has risen, because I have been acquiring Netflix last week. I will be talking about what I'm going to be doing this week a little bit, just like plans. Of course, all of this is subject to change, because in the moment of execution, something might change my mind in the last minute. So, any thoughts on someone who bought into Baba way too much? I mean, well, people bought into Baba based on the premise that the fundamentals of the business are sound. Of course, you know my opinion about that. Not saying that the nominal fundamentals aren't sound. They are sound. They're very sound. It's just about my whole issues with the VIE, which I did see someone ask a question about the VIEs. Thoughts on Chinese versus Taiwanese VIEs? Would you also treat no, I would not treat Taiwanese VIEs, if there were any in question, as Chinese VIEs. No, I wouldn't treat them the same. Treat them as two distinct things. And in particular, I mean, we're talking about one VIE with another VIE, just like I would look at an American VIE, and because VIE is an umbrella term. So I'm going off of the academic perspectives. If you're looking at a Taiwanese VIE, a Chinese VIE, no, wouldn't look at them the same. A United States VIE, a British VIE, and a Chinese VIE also wouldn't look at them the same. Each VIE should be looked individually and in their own distinct manner. Technically speaking, just tends to be that some VIEs follow the same structure format. So yes, but yeah, that kind of culminates into my thoughts on Baba. You have to understand that was the whole point of me making that whole video series on that. And this is to go on YouTube forever, to forever be marked on YouTube. And, as many people as can see it, and they don't care about it, fine. They do care about it, fine also. That's the whole point of that whole video series, is to, if you are involved in this, you have to be comfortable with that and all that it entails. Okay. Of course, because my portfolio is not your portfolio, so we can have completely different results or you could say focuses. So yeah. Okay, Julius, talk about this. Okay, you're talking about that. Fabio, if you have to invest money right now, Meta or Netflix, can't pick both. I saw your question on Strongman's live stream. You asked a similar question. I don't want to always talk over, because I'm a guest on that show. I don't want to talk over anyone. But my answer to that is, I'm more I would love to own more Meta than Netflix, but Netflix, where it is at, I'm very happy with the cost basis that I kind of lowered it to. It can actually go up from there. But I will say this, because you guys probably know because I've had questions from subscribers in the past during the live streams. Oh, how much do you have in cash? Because I only show the portfolio allocation stuff. I'll just say, like, I'm kind of actually thinking about deploying more and more capital in a little bit more aggressively soon. Of course, this is kind of subject to change. It kind of depends, because I also want to focus on having an ample amount of cash for real estate as opportunities arise. So I'm kind of trying to balance everything together. But at the capital markets, as in the equity markets, present opportunities right now, I don't know if I won't be able to help myself, So, and we've drawn down the ConocoPhillips position a lot. So I still have that kind of just waiting on the sides. I redeployed the Activision Blizzard. You guys already know that, but and I redeployed it, like, basically back into Activision Blizzard. So okay, so oh, you guys are talking about gas here. Thoughts on investing in copper? Huge draw in the Peru and Chile, who are, well, I had exposure of copper through my Ryokan and BHP. I think BHP mainly, but actually no, one of them doesn't do one or the other. Oh my gosh, I forgot off the top of my head. These guys are so big. They're not like focused like what's that other company called? Oh, the company escapes me. There's a pure play company for copper, Southern Copper Corporation. That's the one, Southern Copper Corporation. That one was not, I didn't participate in that, but I have a friend who did, and he's more focused on copper. I can probably just ask him what he thinks about copper, but I'm pretty sure he was actually also exiting his copper position. So I'm kind of giving you by proxy an opinion of someone I've spoken about. So that's the extent of the value I can provide in terms of that. But yeah, it could continue, like, but the cure to high prices in those commodities is high prices, and incurs a lot of expense. However, you have to be careful, because sometimes that suppliers are incapable of providing that supply, and then that can cause an extended drought, so to speak, of a particular commodity. So Meta will make me rich. Are you in Meta too, Fabio? Yes, I am in Meta. I am in Meta. I see your question. Meta will make me rich. I saw your other questions. All right, thoughts about sectors of the market that may perform well, poorly in the coming years. So anything that has to do, well, years. Geez, we're extending the time frame a lot. I mean, I'd be cautious on anything that relies heavily on ample liquidity. Because, I mean, we talked about it, like how China went through their liquidity crunch earlier than the United States. The United States was going through it starting November, December-ish, but the effects started showing up more in January, February, and now everyone's talking about it. They're either calling it liquidity crisis. No one's using the word liquidity crunch, but using the word liquidity crisis, which is the same thing. But yeah, I'd be cautious on any industry affected like that. If you watch, in each of the videos that I do on a particular stock, when it's a subscriber request, I do say in those videos whether or not those would be subject to or victim to the liquidity crunch. The Palantir video, I'll spoil this. I do show an old video of Palantir. I only have one video of Palantir on the channel, and it's showing that why it is that I sold. And I don't like to do those videos unless there's a case study to be derived from it. In the conclusion part, I think around minute 16, and I'm not like a freak or anything. It's not that I have it memorized like that. It's because I had to rewatch my own video to then comment on my previous thoughts. Okay. It's not like I memorized it from all the way back then, because it's a video from February. I don't have that kind of brain. But around minute 16 in that video, I do talk about how Palantir may or may not have been affected by not may or may not, has been affected by a liquidity crunch and might continue to do so. And the price at that time was like around $11.77. Today it's around $8. So, but yeah. So that was in February. Now we are where we are today. All right. So after nickel, smaller debt. Oh my gosh, this thing keeps like jumping down to the bottom because it's like new comments. After nickel short seller debacle. Yeah. Like, I mean, that's another thing to consider, but I don't really have much exposure to metal. I got a question asking me to look at ticker symbol X, so United States Steel Corporation, which again, I'm not really like the best one. I'm not focused on that kind of stuff. So, but yeah. All right. Did SBUX bottom? I mean, let's actually, I'll take a look, and per SBUX stock. Let me shove you guys over here. As always, I'm going to show you guys over here because the vertical screen is better for you guys to be here, and then I'll share it on the wide screen, the actual screen. So, because I've had feedback saying that the vertical screen looks funky when I share it. All right, so this should look good. I'll try to zoom in because let me see. I'm looking to the left to see what you guys see. Okay, so that should be good. All right, so Starbucks is at $75, 8% on Friday over the 5 days. Okay, they had this nice little bump up, and I bet you that's like, yeah, that was earnings. So, or no, that might not have been earnings. That might be earnings and might not be earnings. I forget when they report earnings. It was pretty recent though. And I remember from the numbers because I did take a look. It was China was doing poorly, but United States picked up the slack and they did actually really well. Only because of the United States. But yeah, and the new CEO, I really like him. I did not like the old CEO actually, even though the old CEO was kind of responsible for this draw up in the stock price because he did basically the stock buyback program, bought back tons of stock, returned tons of capital to shareholders, and over the time period where Howard Schultz was in power, so to speak, for this brief period, it was just going nowhere, and he kind of just left to do his own thing. And then you had this massive run up. I think this guy was a good case study of a CEO that like uses up the company's resources, perhaps in the not the best way possible to achieve a certain goal, specifically price go up goal. And I like that Howard Schultz is back because I think he's going to steer the company in the right direction again. So I would actually consider myself, I would consider Starbucks, and I'm going to do an analysis, an updated analysis on Starbucks. So that's going to be coming, but I don't know if it's necessarily bottomed. It depends on how things kind of play out. So like, because I've been saying in the past, I think that back then when I was stating this, that a recession was probable, and I wouldn't be surprised if we had one, but I won't make a claim to know how severe it would be. I wouldn't know until we're kind of like there. A lot of people are going to make claims as to how severe something can get, and that's kind of okay. Maybe they make the case and they can outline specifically why it will be that bad, and then you can be the judge and say, okay, did those things happen? And that's what I want to be very clear. So when someone makes a claim, as you as viewers should ask them, how is that going to happen? And will that and did that manifest? And then judge them on that. Don't let someone say something will be bad or like this will be a bad year. Make sure that they tell you how it will be a bad year. Because then the claim itself doesn't have have any sort of value because anyone can be lucky, right? They can just guess this is going to be a bad year. So I'll say like right now, like, next year is going to be a good year. We're going to have a positive stock market. And there's not going to be a recession. There's going to be a massive run. Economy is going to grow a lot. Then if I don't say to you exactly why, I'm literally then that's evidence. I'm kind of like just pulling it out of my rear end. So, when someone says liquidity crunch, liquidity crisis, make sure that a person also tells you the mechanism for how it occurs, which is, precise. And I don't say like someone has to tell you how severe something will get, because then that's asking too much. So I was asking like for the person to probably have like a crystal ball. So then like if you ask me in a separate way or in a like, let's say the question is phrased this way. In your opinion, how bad might something be? And I would respond to you in kind saying, well, in my opinion, and this is where I'll answer that question. I think that it will be moderately bad, like not that bad, but moderately bad. It's kind of like you might feel the recession bit, but not as severe as other recessions in the past of the United States. I don't think this is the big one, so to speak, but that's just my opinion. And then, so the accuracy of that, put a grain of salt on that. I just think personally that we might have one, and I won't be surprised. I've been saying that for a while, but I don't want to say as a statement of fact how severe it will be. All right. So that's just a little quick tirade there. This is a funny joke. They're about to be Taiwan companies are about to be Chinese VIEs. Yeah, maybe. Okay, so I am looking at industrials recently. I'm looking at, and I'll tell you which ones. I'm looking at Leggett & Platt, ticker symbol LEG, Cummins, CMI, which you mentioned right there. I'm not looking at Owens Corning, which is OC. I'm also looking at Stanley Black & Decker, which is SWK. I forget which one's a PH. I forget that ticker. I don't have all the tickers memorized, but Parker Hannifin. Okay, Parker Hannifin. No, I'm not looking at this one, but you just brought onto my list. I shall look at it now. So, yeah. So he's answering your question there. Yes, a Meta. I'm a huge Meta bull. Well, I've been a Meta bull for quite some time. I've just been taking advantage, increasing my position, and ruining my cost basis on Meta. but going against my psychology there. Um, and so this is a thought shared by many people, by the way. So yes, this is the thought. So the thought process here, and I'll kind of try to represent you reasonably, is that Alibaba is the largest company, or no, the second largest company within China. And so the belief there is that they want to become the most powerful country in the world. They want to grow these businesses as big as they possibly can. So they're not going to screw foreign investors with those companies. That's the thought process there. Fabio, any thoughts on rating agencies? Maybe rich valuations, but well, those are cash cows, and they're not going to go anywhere. Very high barriers to entry, a lot of quality in those companies. So if you ever get them at great prices, the market's probably insane, or something terrible is happening. So, I mean, the thing is, once it's quite obvious that a company has a fantastic business model, it's very high barriers to entry, the market then identifies it, it's going to be trading at a premium, at a relative premium to the rest of the market, which, you know, is unfortunate. So then you have to try to find the ones, and easier said than done, by the way. When I say these statements, I have to clarify, easier said than done. Finding a company with good moat, strong business, and the market's not appreciating it. Easier said than done. But those are, yes, an example of one that the whole market already identifies it as. Yeah, you see, Baba is a great business, but the China economy is collapsing. I think there's been more defaults recently, because we've talked in the past a little bit about, you know, the defaults going on. You probably saw a bunch of YouTubers. So I didn't make a ton of videos. I didn't milk that. I don't believe in like milking content when something's really going on. I might make one video and that's about it, unless there are new updates that I want to share that are, you know, big drastic differences. I know that that's probably hurting the growth strategy of the channel, because during an event you want to make sometimes as many videos as possible on that topic, but I don't want to do that. It's not. I also have to be strategic with my time, because this is not my job. So I have to be strategic with exactly what I cover. Okay, so hella funny, Tom. I skipped. It brought me down all the way to the bottom, so now I have to go back up, see where I was. I see that some of your stocks that you're within your strategy within buy prices. What is your gulp price for Netflix? Gulp, like absolutely insane buying. I think it's like set to below. When I take a look at it last, it's set to below $130. $130 is like, I'm just buying hand over fist, can't get enough shares, something like that. Within the realm of change, by the way, because things can change if the facts change. Opinions can change. The facts change. Okay, so propaganda video constantly on YouTube, and say that. Yeah, so you'll see the new Palantir video, and yes, so whatever it is, I forgot what it was, but oh, I get it, because the prices, yeah. All right, so T Rowe price thoughts. Oh, Tom, like Tom Nash. I don't know who liked Tom. Something else. Okay, so I'm going over. I'm trying to find the ones. Okay, Crocs was at $50. Your worst case was $50 price target. They raised guidance, beat everything. Thoughts? Yeah, I have to revisit what I said about Crocs, because believe it or not, I mean, there's like over 200 videos on the Capital Mindset Show now. And so I wish I had the brain capacity to memorize everything I've ever said about the stock. So literally when I do those videos, when I revisit things, I actually have to rewatch my old video and listen to what it is that I said. And I hope every time that I was like, I hope I was, you know, rational back then. And luckily, most of the time so far, I have been. But sometimes I have disagreed with myself, and I'll mention it here and there. So Crocs, yeah. So you're referencing an old video on Crocs where I basically, I don't know what my exact thoughts on it were, but I imagine that I was a little bit cautious, because if I thought it was a stupid deal, I would have bought it. You know, I'm not like a, you know, I'm not completely foolish that I see, oh, this is a great deal, and I think it's a great deal, I'm not going to buy it. I don't do that. But in that sense, did I talk about any risks? I have to rewatch the video, like quite literally, because when I do the research, I like forget about it, because I'm going to be researching a ton of other stocks. For my thought process, I might have talked about the potential demand that was brought forward and how that might be affecting the numbers, and why the market might not believe Crocs' guidance in let's say 3 to 5 years from now. But yeah, that some things I need to know about what I said. I think Kellogg's is kind of overvalued. And Julius also says that Starbucks has more drawdown, but Kellogg's, by the way, is like a bond-like instrument. And I know that's going to make people cringe, especially if you work in finance because it's like, no, it's not, because it doesn't have the risk profile of a bond. I know. And when I say risk profile, I mean like technically less risk because it's common equity. But in terms of like how some people treat it within their portfolio, they treat it like a bond-like instrument. There's a lot of stocks that I can mention off the top of my head that people treat it kind of like a bond-like instrument. Basically, it's a cash cow. You don't expect much growth from it. This is what I'm talking about. It's a mature industry, a mature business, and you're just kind of collecting the dividend. That's basically the return that you're going to receive from it. And that's basically it. If you kind of look at, let me actually pull up Kellogg's to kind of talk about it real quick. But you can see, okay, so 3.18% dividend yield. I think more recently they've had the pop. So you can see there the little pop. This is kind of a flight to safety stock also. Not only is it like considered a bond-like instrument, you see it from this really bottom right here, March, about a 20% pop there. But over the past 5 years, it's done nothing. It's 2.71%. So again, most of that return has been through the dividend, like I said. Of course, this could change. Like they could, find something, but even the max returns going back all the way to 1982 is about 383%, excluding dividends. To be very careful there. But yeah, more recently, it's kind of entered its very mature phase. Very difficult for it to find any growth. Kind of just doing buybacks, issuing dividends, and you could probably reinvest the dividends. It'd be difficult to outperform the market, but maybe that's not the goal of the investor in Kellogg's. Okay, so I've been getting Clover Health, and thoughts on PayPal. So I'll cover both. So PayPal, I've actually will do an update video on PayPal because this is one, PYPL. It's one I've been assigned to research. So I am actually doing research on PayPal right now. But yeah, basically, just some quick thoughts because I'll put the rest of the thoughts into the dedicated video. Around here, I was already saying, I made videos. You can probably have already seen those videos, that it was overvalued. Even when it was at $100 of saying it was overvalued, still it wasn't worth the risk at the time. Then now it's at $78.83. So, I mean, I think it reached, what was the low? Let me see. The low was like, 74.29. That's not technically the actual low. It's just the day low, the closing low. But yeah, I mean, things with PayPal is it's in a business line that is always trying to race to the bottom, always trying to provide cheaper and cheaper costs to the customer. And then you have a lot of competition coming in this fintech space, a lot. You have, for example, some that we've talked about, Stripe. You also have Payoneer, for example. You have, what's the other one? Well, Stripe was one. What was the other one? Wise, TransferWise, which is now called Wise. You have a bunch across the world. You also have Global Payment Systems, which is one we talked about in the last live stream, that they do actually compete with PayPal in some degree. You have Square, that is, or now called Block, competing on PayPal. You have Apple. You have all these competitors really coming in and trying to take some of PayPal's share, making it difficult for PayPal to expand. Not impossible, but difficult. And again, you're in a business line that there's kind of like a race to the bottom. And what you really have to focus on is trust for the customer, convenience for the customer, and cost for the customer. And all those have to improve constantly because your competitors are always improving constantly. And so I don't use any of PayPal services, for example, because I can use a combination of the other services and have a much lower cost structure for myself to transfer money around the world. Then you have also, in essence, in the United States, at least, Zelle. I don't know about if it's available elsewhere in the world, but it might be. I haven't actually looked into that. But Zelle is a free option within the banks. And so, there's that. There's obviously limitations to it, but yeah. And then Clover, you're talking about Clover Health. So that's the insurance company. Let me see that one, because that one's probably down a lot. This is one stock that it is down a lot, because this is one stock that I would have been expecting to have be a massive victim of the liquidity crunch. Okay, so 5 years. Well, it's not even around for 5 years, but it's down 74.41% all time. 1 year is down 61.6%. And yeah, you can probably even map out. This was another. Oh, this is a good example. Canary in the coal mine. Another one right here. So one that was kind of showing you, or being an early warning sign. Look at that perfect timing in November. So early canary in the coal mine was kind of indicating to you, oh, things are getting pretty bad. And here we are today. So thoughts on it. I'd have to see what the specific value proposition of is, and whether or not they can actually provide efficient value, which, by the way, I have already filmed a couple videos within the Pay What You Want course. And in the, I think the first video number 1, I actually talk about profits or what they are philosophically as efficiency use of resources or efficient use of resources. It's a measure of that. So I don't know why I'm saying that pertinent to this, but I want to see like how they plan on being efficient with their resources, you know, and another way of saying measuring profitability. Can you take a quick look at CD Projekt Red for the love of The Witcher? Well, I can, and I know that video game stocks are kind of under fire. The thing with CD Projekt Red, and I will tell you right now, and this is a big problem with this company in particular, is actually overexposure to certain video games. Where, for example, they had Cyberpunk. Cyberpunk was the most recent game that came out. It didn't do as well as it could have been. And so the next game, hopefully they come out with something related to The Witcher or something related, but they don't have as many titles. They're a much smaller video game company relative to something like EA, Activision, Take-Two Interactive. That doesn't mean they can't succeed, but it does mean that you probably are more exposed to the success or detriment of a particular few select titles. So I can do a dedicated video on CD Projekt Red because I actually wanted to. I actually already thought about this company because I know it's right now it's not liked with the whole thing that happened with Cyberpunk. And that was actually, I think, this debacle around here. And so it's fallen drastically. And now it might be a better risk reward than it was back then. I mean, obviously, that I'm stating the obvious there. But yeah. G. Andrews, this is talking about someone 68. Starbucks. You guys are talking about Starbucks. Hey, what's good, Noam? This year, 2022, will likely be a bad year because of the decreasing relative and absolute ruse. That's good. I bought Hood puts on Tuesday, was up 100%, and now the crypto bought a bunch of Hood 2 days later. At least I did go through with the Piton puts as well. I mean, yeah, that's the risk because with puts you have timing risk. Timing risk is a big problem with options. You have to consider that. My wife actually owns Archer Daniels Midland. She is up a stupid amount. She's held Archer Daniels Midland for quite some time. Her portfolio, she has some stocks that are considered to be extreme conservative and some stocks that are considered to be extreme aggressive. So she's held, and I don't really comment on her portfolio much because she doesn't have a YouTube channel and she doesn't want to reveal this, but I can just talk about it slightly. You don't know the sizing or anything, so it's fine. But I'll say I don't own Archer Daniels Midland because she owns Archer Daniels Midland. And so because of that, we kind of think of it in a diversified way. I won't get that exposure, but she has a lot of Archers and Tyson Foods as well. She has like a theme of her portfolio. And it is interesting the different strategies that we both employ. Yeah, that's all I'll say. Good afternoon. And yes, I briefly mentioned Leggett and Platt. UGI I have not mentioned yet, but yes. Okay, so scrolling through. Do you feel to follow All In podcast? They have great takes on the economy and investing. No, I actually don't listen to any podcasts about economics, but I'm open to the idea. I'm open to the idea of listening to some podcasts or even creating a podcast. I don't know, but if I have the time. I hold a small position. OC owns Corning. Predicted the bottom out of the ruse, basically. That's fun. All right, Fabio, what makes you think that a recession is probable in America? I'm not asking about the severity of it. Just why do you think that it is probable? Well, because from one of the symptoms of a liquidity crunch that I've been talking about for a long time now, and why they kind of connect together, is because a liquidity crunch can cause a decent drawdown in consumption, which then remember that your consumption is someone else's income. So if we see a drawdown in consumption, we see drawdowns in incomes. We see drawdowns in incomes. We see drawdowns in the appetite for labor force expenditure. And that then leads to a drawdown in the employment rate. And then that then leads to further drawdown in consumption. So, of course, there's kind of like an implicit bottom in that because obviously we don't go to like zero because it just cascades to nothing. It's kind of just like filtering out the inefficiencies that kind of accumulated into the system. And depending on how bad those efficiencies were, that's like the recession. So we have to remember that the liquidity crunch in part is also caused by the massive effects caused by the lockdowns. A lot of people say it was pandemic. My problem with that is it doesn't actually prescribe the proper blame. It was the lockdowns, not the pandemic of nature. The virus doesn't really do much in that sense. The lockdowns themselves were really what really affected supply chains, if you really break it down into the technicality of it. But yeah, so we're still going to deal with those repercussions in a variety of ways, and in some ways that are unknown to us right now. So for example, the chip shortage, we thought it was going to end in 2020. Oh, and by the way, like for the lockdown comment, let me explain further. Like, look at China. We don't say it's the virus anymore with the China lockdowns. We usually talk about the lockdowns as they are lockdowns, and that's causing its problems within China. But going back to the chips, we thought that Intel was going to have, or most semiconductors were going to have their supply chains fixed in 2023. Turns out it might happen in 2024. This is according to those companies. So, yeah, sounds like GoPro. I will be doing the video on INMD. Make sure that when it comes up to vote, that you're there in the voting booth in the Discord, letting your voice be heard. Because that, remember that I have finite time. I have a lot of requests, and I'm trying to not be rude at all with that comment, by the way. But I have a lot finite time. And it's just how do you say, a limitation of biology of life. There's only one of me, so my limitation on time, I had to, out of necessity, create the voting system, because I cannot cover all stocks. And remember that my workplace requires me to do research on individual stocks as well at times, and also private companies. But when I do that, that takes up a crazy amount of my time. So then I have to be very limited. And sometimes I have more open days than others. And so I try my best. And you see, sometimes I spam out videos and other days I don't. It's because of that. My days are sporadic. And I know that that's actually technically bad for the algorithm. But I know it's what it is, that the goal is not necessarily to just grow at all costs. It's just to, provide the value I think I provide. And yeah, it's, again, because it's fun for me, All right. Anyways, how do you determine your nibble gulp price targets? Depending on my confidence within that price. I know it's like kind of like a vague answer, but yeah. Could you do through the model? What I forgot. Oh my gosh, I don't remember what WSM is. Why can't I remember that? What is this? Williams Sonoma. Okay, Williams Sonoma. I'm trying to keep us from getting into the model, but I might do towards the end, because I also have limited time today, because I have to actually get back to work at some point. And yes, I am working on a Sunday, so I'm taking like a little bit of a break, but I can write it down to, well, actually, no, that's already on the list. I already know. I actually saw that the other day. I was actually trying to categorize them. I already answered that question. Is something done? Open is a good example of what would be cool to watch and analyze the company, please. Yes. Okay, fine. I shall. Well, actually, remember, I think I think it's gonna. I think I have it set to actually go up to vote this week, and I don't only pick the winner. I also pick the runner up. So like another video that won, it's like the runner up. It won was the Joseph Carlson portfolio review. That was the runner up to last week's. AMD was the winner. The runner up was also, and I also did the runner up the previous week. So I also do the runner up. So don't think just because it loses doesn't mean I don't do that video. I just kind of, it helps me organize priority. That's all it does. The voting helps me organize priority. Okay, so Seeking Alpha, realize. Seeking Alpha Quant really likes AOSL, but to me it looks like just an average semiconductor manufacturer with no. Well, I mean, quant rankings on Seeking Alpha are what they are. It's like they are what they are. I see that. By the way, this Williams Sonoma stock. This is the last comment I'm going to make on it. I see that there is a lot of interest in it, but again, it's these two. I don't think WSM was put on the list for vote this week, but I'm going to go ahead and put it on the vote, because I see it asked actually more often than you think. And Open Door for sure is going to go on to the voting block. So, all right, how do you define a high quality business? Does having good historical returns ratios mean it's a high quality business? Yeah, I mean, but you got to be careful on the over reliance on that. High quality business is as much of a quantitative metric as it is a qualitative metric. So I think that a seasoned investor has the capability to kind of rationalize quality So, you know, for example, look at companies that you consider to be absolutely high quality businesses, and then try to find the characteristics that distinguish them as high quality. And then from there, compare it to the company in question that you're looking at. Do they share any of those characteristics? And then that should answer your question. Oh, Verizon, yeah, that's another like bond-like instrument. Do you ever front load your IRA into VU or DCA? Would you, not do you? Would you front load an IRA into VU or DCA this year? Let me see what VU's at. I haven't actually paid attention to these guys in a bit. All right, so I'll just do that one. And these, oh, not CNBC, DCA stock. Oh, dollar cost average. I was like, is that a stock? I was like, I had to search that one up. So, oh, I'm reading your question wrong. My brain's like stopped working. So too many acronyms. I can't, it's overloading me. So would you load an IRA? And also the text is technically smaller for me, not for you guys. But would you front load an IRA into VU or dollar cost average this year? Okay, now I get the question. My brain is back to functioning. Okay, so VU, like, okay. I mean, where are we at? What was the total year return year to date? Year to date, we are down 15.96%. So it is a quote unquote bad year right now. Okay. The thing is, technically, the mogul model, you're supposed to dollar cost average. So then, according to Jack Bogle, sorry, not mogul. Oh my gosh, Bogle, you should DCA. Okay, not according to me. That's according to Jack Bogle. That is the optimal strategy, because you don't know if we're going to go any lower. But that depends. Like, do you care? Okay, do you care? Do you think this is low enough for you? What is a good price for you? Maybe it's still overvalued. Maybe it's not overvalued. Depends on you as the investor. But I think dollar cost averaging tends to be, I would prefer to still have firepower if things get lower than to miss the bottom. That's my preference, but some people are different. Okay. BND is like a bond. Tesla's 510 announcement on superchargers will support CSS charge to non-Teslas. Is their push to increase? No, that was beautiful. That's a very good decision. I think they should be doing that. They should become a gas station of sorts for all vehicles. They should be able to do it for everyone, and that makes them very competitive. Opens up that business line to be a very serious competitor. And, you know, like, let's use hyperbolic language. Tesla will also take over the gas station industry. Hey, there you go. And then you have the Tesla convenience store. I'm just kidding, but, you know, not also half kidding. But I think that that's smart. And I want to recognize, or everyone to recognize it. While I do think Tesla stock is overvalued, I think the business is great. I think the cars are great. Obviously, a little bit biased there. But I also think, and I acknowledge and appreciate competition within those business lines. And I'm not going to be blind to that competition, as well as I'm not going to blindly love the competition because I hate Tesla. I hope to everyone to think of me as kind of like a neutral person when it comes to analyzing the business. And I'm not like a Tesla hater. I'm not a Tesla lover. I'm kind of just, you know, there. And so, you know, I think that there's a lot going for it. And I'll tell you this, from those of you, I don't know if you guys know this, but I recently did buy a car. Let me actually check on the delivery times to see if it has changed. So you go on, it's so convenient because you just go on the app. It's very easy to buy, by the way. It's extremely easy to buy. But yeah, let me see. It's loading. Okay. August 28th to October 9th. So it hasn't changed the delivery date, but it was very convenient for me as a user to purchase the vehicle. And it was very easy for me also to submit my trade-in. To file the paperwork for my trade-in. Very simple. Now the financing, I already discussed how basically I'm going to be buying it again, because I'm basically changing in the old one, changing in my used car, because used car prices are getting a good price. So I sold it, and then I can get that money, and then I'm basically get more value than I would have otherwise otherwise gotten for in a normal market. So I'm taking advantage of that. And I also am getting a little bit more my favorite color. I love blue, by the way. Fun fact. I love the color blue. So I'm getting it in blue this time, and just a couple other things. But anyway, that's not what you're talking about. Talking about Tesla's avenues or adventures into other business lines. I think it's a beautiful thing. I think it's great that they're doing that, and that it's going to make them more competitive in that category. They can be competitive. I just don't think that the price right now justifies it. All right, so let's see. all these comments. Okay, it took me all the way down to the bottom, so now I have to go back up. I don't know what it does. Fabio Mindset. Heck yeah. There is actually a YouTube channel or a YouTube user called Fabio Mindset, by the way. I don't know if his name is actually Fabio, but he comments here and there. He used to have a different name. I know his, I'm not going to name drop him, but he used to have a different name. Yes. So I saw your AMD video. Is a required rate of return for stocks 15%? So if you noticed, if you notice this, if you like pay attention to the absolute details, you remember when in January, February, around there, my discount rates were about 20-ish% most of the time. And then the rare ones were 15%. Now you're seeing more 15% and 20%. Coincidence? I think not. That's all I'll say there. But coincidence? I think not. And yeah, so I saw your AMD video as your required rate of return for stocks. Yeah, about 15% for AMD. I know, and it's particular to the business. I'll do it. But coincidence? I think not. I'll say that. All right. So index Wise is amazing. Oh wow. So I'm just catching up to comments about Wise. Oh gosh. At this point, actually, because let's say professionally, because I don't invest other people's money. I don't do that, so I'm not a professional in that sense. But investing individually, I've been doing since my high school year, so going on a decade now. But to the levels of skill or degree that I would say that I had in my past or knowledge, it was an exploration more so. So keep that in mind. But yeah, going on a decade. We're approaching a decade very soon. I think in about 1 year, we're going to be approaching a decade or so, close to that. Yeah. I think that, and if you have kids, start them early, and then they can kind of learn through the process. But yeah, if you have kids, just start them early, so then they can get to a decade of experience fast. Let them make mistakes, guide them through it. It's really good to start them early. Okay. And not just like, let's say it's not stocks, but like just investing concepts in general. Just get them to understand the money and like what to invest. And that's what I'm going to do with my kids. So I don't know about you guys, but that's just my thing. A quick little side comment there. Okay, Fabio, do you retained earnings on a company balance sheet? Fabio, how do you review retained earnings on a balance sheet? Well, I mean, like, okay, so RE, I'll look at RE depending on the business. Like some companies have negative ROE, but it's not necessarily a concern if the company is basically literally a cash cow. Then RE negative, I don't really care. Pharmaceuticals, a lot of companies in the pharmaceutical sector tend to have a negative RE. And so the answer to your question is entirely depends on what company we're looking at. Like I say, the one thing you get from Capital Mindset, hopefully anyone, is just investing is nuance. That's the biggest takeaway from my channel. If my channel stops tomorrow and no more videos, that's the lesson I hope everyone just remembers. Investing is nuanced. There you go. Done. All right. So thoughts on short arc. My good friend Austin, he's been invested in short arc. He's up like 50-something%. So he's doing really good. I did not buy it, but we were talking about when he did buy it. For those of you who do remember Austin, he's doing really well in his portfolio because he bought a decent chunk of SARK, and SARK had already gone up a decent amount, and then he bought it, and then it went up another 50%, and he benefited, and he's up 50%. So, but great ETF for that was, I mean, gosh, if I could go back in time and really play the liquidity crunch optimally, it would be selling the shares I did sell or stocks I did sell, and then plowing that into SARK. But you see, we all make mistakes. That's a mistake. That's an opportunity cost that I'm going to go through, but it's fine. You're not supposed to think of it that way. Okay, so thoughts on oil prices. I think oil prices, they're obviously high. They're going to affect consumer demand. I think we're seeing that. I think globally we're going to be seeing that. I think the United States is more sheltered than other countries. Europe, we've been talking about in the Discord about the issues with Europe in a bunch of capacities from Europeans, by the way, sharing this data. I think it was very well researched when I was actually taking a look at some of the research they were actually putting out and the images they were showing. A lot of good research there. And, Europe's having its own struggles with a bunch of different commodities, not just oil. And that's kind of manifesting itself in a bunch of opportunities that are playing out right now. So, but oil prices, I think if we do see if the liquidity crunch then manifests itself into the broader economy, we see a massive drawdown in the economy, then you would see oil prices actually come down. But you're going to have other problems to think about as well. So, What are your thoughts on CB? Is this CB? CB? Let me see. Is that a stock? I think that's Chubb. Is that Chubb? Yeah, it's Chubb. Haha. I did a video on Chubb. So Chubb was actually the candidate I used to describe or talk about insurance companies. In a rising rate environment, these are the boys you want. These are the children that you want to invest in. So they have bright futures during rising rate environment. Not banks. Banks make money on the spread. Okay. For those of you who've been watching my live streams, you know the rant. Banks make money on the spread. They don't necessarily make money when rates rise. It can be bad for them if lending growth declines. We have seen that. That's why I sold the banks. So, anyways, insurance companies doing really well. Unum, the insurance company in my portfolio, is doing really well. Markel is another one that's an insurance company not doing so well because they have a lot of exposure to public traded equities. So, not doing as well as Unum. And in that sense, so look at Chubb, look at what's it called? Allstate Insurance, look at Cigna Health, look at a lot of these insurance companies. MetLife, I think, is doing pretty well too. The ones that have pulled back a little bit is like United Health, because United Health was crazy overvalued, but United Health is a fantastic company. Yeah, you can kind of see, even like, where was it? November. Where's November? Yeah, even through November, it's still it's only actually, it's down 1% there. But when most stocks are kind of down, this is still flat. So MetLife, never mind, hasn't done that well compared to other insurance companies in the same category. Okay, so Bobby, when making a valuation model for a company, what is the input to use? Cash flows, EPS, or net income? Entirely. No, yeah, it depends on the company you're looking at. I think you've said it before. Oh, yeah, I just read the rest of your comment. So elaborate on that. So some companies, because of their accounting, because of their specific accounting strategies, not strategies, details, because of specific details regarding their accounting and how they recognize income and revenue and how their business basically lines up. Looking at cash flows can be very hectic. So you have to basically smooth it out or normalize it. So sometimes, because of that, it's just better to look at something like a net income. Or in other times, like let's say in Netflix, it's very difficult to determine the cash flows because you have above the line items of cash flows from operations, you have expenses pertaining to the actual content, and you don't know how much of it is quote unquote growth capex. It's not technically capex, but I call it capex for the sake of it to kind of normalize or blend things together. But growth capex and maintenance capex, or same thing with Disney, same thing with Warner Bros. Discovery. If I were to do Warner Bros. Discovery video right now, I'd have to explain these nuances again, and I will. But you have to be careful not to punish a company for what's called growth capex, and the lines are blurred. You don't really sometimes know what is growth capex and what's not. It's sometimes difficult to determine that, but your valuation won't be that accurate if you're punishing a company for something like growth capex. Look at Amazon. Amazon's has a ton of growth capex, not so much maintenance capex. Buffett's spoken about this extensively. So you don't want to include growth capex into the capex subtraction to find cash flows, which makes it difficult because sometimes some companies don't necessarily explain it very well because they don't really have to. But yeah. Yep. Do you think Bitcoin will go to zero as well? I have no idea with any of that stuff. I have I'm cheerleading something akin to Bitcoin, but I have no stake in the game. The extent to I have exposure to crypto is through Overstock, and that's about it. That is about it. My wife is doing really well, and I don't even want to say how she's doing compared to me because I don't know the answer to that, and I'm also slightly almost like bashful in that. But my wife has done really well. Her selection of stocks have done really well. Of course, I had a hand in helping her, but no. In all seriousness, no. She's really good at breaking things down from the consumer perspective. So if you take like Jeremy's analysis levels, put that to a factor of intelligence of 1,000,000 compared to I'm sorry, that's too mean. Just make it a little bit more sophisticated, and from the perspective of a woman who, by the way, I don't know if this upsets anyone, but by the way, women do actually they're more important consumers than us men. Okay, just so you know, they're more important. A lot of marketing we have to do towards women because they're more important than you if you're a dude. And yeah, so that being said, she also comes from that perspective and tries to provide a practical approach. So she's also invested in companies like Revolve. She doesn't hold it anymore, but she had Revolve, and she understood that when I had no idea. I had zero clue. I looked at that company, I was like, I don't understand this. She's like, trust me, it's like the future, bro. And she didn't say it like that, but I can only imagine she said something like that. That'd be funny. And so she did well in that, but she's like in tuned, I guess, with the consumers. Okay, so how do you have a valuation on Spotify revenue? So I like Spotify. I just don't have a valuation on it because I mean it's actually quite difficult to really understand. I'm still understanding, and like you can see right now, how many months ago did I say I would be evaluating Spotify and that I would be taking my time to understand the business? You can see that I'm still not even there yet. So sometimes research can take me months to really grasp it. Of course, it's not full month dedicated to that one stock. It's kind of like, here and there, I'll do some research on spot, try to wrap my head around it, because I also have to determine the hardest part is determining when I would like to participate in it. What would be the buy price? And I'm not the one who needs to own it in order to pay attention to it. I can pay attention without owning one share. Some people do that as a strategy. Nothing wrong with that. But I've just been, trying to learn it. And maybe I conclude at the end of all this not for me. And if I do that, I don't consider it a waste of time. I consider it that I've learned a lot about a company that I otherwise did not know about before. So it's still time well spent, and it's fun. But yeah. Thoughts on Domino's Pizza DPZ? Great company, shown to actually be very adaptable. And as far as pizza goes, not bad. Okay, from a consumer standpoint. So as far as the cheap pizzas goes, not bad. And they were all about the omni-channel experience. Order pizza however you want. I know why you're asking, because they had this drawdown here, and they were, in my opinion, I mean, quite obviously now, but if I had done a video back then, you kind of could guess exactly what I would have said. I would have probably said it was overvalued. If I do a video now, it's probably preliminary thought. I'm probably going to say it is richly priced. Probably going to say that. But yeah, definitely worth a look. Yeah, I think this is always a company used as a case study next to something like Alphabet, that this has outperformed Alphabet, and why the importance of what you pay for matters. Well, I'll say that again, in today's sense, from the modern day perspective, yes, what you pay for Domino's will matter and how well you will perform in the future. So that hasn't changed. None of that has changed. Oh gosh, I'm so happy you brought that up, Brian. I will get to your comment. I see your comment on Nautilus. Okay, because I have some things to say regarding Nautilus, because I don't know. But yeah, all right. So European lockdown as well. Okay, wow, I'm still catching up. Again, you can see why I take some times to go through the comments, because in this live stream, at least, I try my best. In the future, it will not be possible. I hope you guys acknowledge that. In the future, this may not be possible for me to do, but I try to go through all the comments, the questions, and try to give you not just a surface level answer. Try. If it's too deep of a question, then I have to kind of glance over it, unfortunately, but all right. So thoughts on Nautilus. Nautilus, I did a video on Nautilus at ticker symbol NLS, by the way. And this company, at the time of when I did the video, I stated it was more like a value trap. And I forget what price it was. And actually, you know what? Let's pull it up. We won't play it, but I just want to see the date and the price it was. So, and this is what I do, by the way, oftentimes to search for my own videos. So I do capital mindset, and I put the ticker symbol next to it. And so, most of the time it actually will work and it will come out. So I will now bring it over here, and you guys should be able to see it. Yeah, you guys can see it. So look at that hair, terrible hair at the time. I was having a bad hair day. I did not care. I think I probably woke up and then did this video. But anyway, enough roasting myself. You can see I had like this message at the beginning of the video when I had different hair, because there was like some change or whatever that occurred. Point is, January 11th, 2022 was the publishing of this video. I think it was filmed before then, but I care about the price. Let's go here. The price, $5.73. And, yeah, was it? Yeah, $5.73. And now it's at $2.48. So it's down about 50-ish%. But if you actually look at the year to date, I think it was up even higher than that. And even 1 year from then, it was all the way up here. Like, this is crazy. This was like the Peloton stay-at-home phase. Like, oh my gosh, if you held, you're down 91%. So, unfortunate. But I did say in this video that video that I just showed you, that basically there was this cash pile that the subscriber who requested it was referencing as a point of why the company was a value, right? They were saying it had a lot of cash, and it did at the time, or it did back then. And people, if you looked at, depending on the website, and you have to be careful, and I was actually pointing that out, be careful of the source, the website you use, because, you know, you might have to look a little bit deeper. So look at the quarterly filings to get the most up-to-date balance sheet data, because the cash was sitting at 100 million in the annual, and then when you looked at the quarterly, it was down to like I think it was like 200 mil, something like that. But it was a lot in the annual. It went down a lot in the quarterly because they repurchased inventory, so they had to stock up on inventory. And the company itself was stating that inventory was a bit of a problem. So when you break that down, the bullish reason of why that subscriber requested that in the first place kind of vanished right then and there. So, you know, then I highlighted that. And then some commentator was also coming in and saying like, oh, what are you saying about the cash and transferring it? I didn't think the commentator was understanding what it is I was stating. This was actually a recent commentator, because now it's, you know, a library of videos that you can go in the past now. But regardless, the point is, Nautilus seem to have been expensing a ton of cash to get inventory. That's all well and good because they're in the business of that, and that's what they have to do. But the reason to say that the cash pile is a safety net is gone. Okay. And so now you have to worry about what they're really priced for. I'll say this: they look like they're priced for bankruptcy now. So if they're not going to go bankrupt, maybe it's a good deal. But companies like this go bankrupt all the time. This is a hard business. I'll say that. Peloton is a hard business too. They're in the same industry. So yeah, that's all I'll say there. What do you think about my proposal to get into a war, take prisoners, use them as I don't know about that, but yeah. I don't know about that. It, I mean, I don't know about that, but will Elon Twitter deal go through? No idea. Probably yes, I would say. But, you know, right now you're not really let's pull it up, because I think I have to refresh myself with the stock price. Even though I looked at it yesterday, forgot about it. 9% down. Wow, yeah, that's pretty decent delta now. So, I mean, if it does go through, I mean, crazy return potential. I'm telling you right now, between $54.5. So, is it worth the risk? I don't know. If it got to like $30-ish, like where it was around here, I'd say that's pretty much. I'm eyeballing it, by the way. So consider that in your accuracy. But I'm eyeballing. I'd say that right now is not it's not the worst price in the world. If you really do believe it's going to go through, but that depends. I'm not participating in that one, but I'm participating in Activisions. What do you think about Crocs at $58? I was asked this question, Hamad, but I'd have to really relook at it. I really do have to rewatch my video, because I don't have all my statements ever memorized, but I have to really rewatch that video. If you haven't seen my video on Crocs, watch that video, or someone can actually maybe comment and say what it is that I did say in that video briefly, as quickly as possible. And then I can kind of, you know, talk about it, but I don't remember what I said. Okay. So how do scaling in and out? I mean, it's an art and a science, you see. So like, it's not really a science on scaling in and out, but if the prices are within the range that I've decided, I usually designate it as nibble, bite, and gulp. I know it's funny names. People laugh at it, but because I'm a comedian, right? I do stand up. No, I don't do stand up, but it depends on the price. It depends on where I see the industry outlook, how confident I am, and also, do I like the company? And that's more of like a qualitative measure than a quantitative measure. So I might not like a company, but I think it's a very cheap value, and so I might add it, but not at a huge range. So I might not allocate a ton of capital to it. And that is to make sure that I'm comfortable with what I own, because psychologically, I think an investor should be comfortable with what you own. Otherwise, you know, you're asking for it. Okay, so boo my boo. South Park Index. Wait, what is the South Park Index? I don't even know what that is. I never heard of it. That sounds awesome. Why you don't buy an why don't I buy an ETF? To be honest, because I don't know. I prefer to allocate things myself. I like to have my own control over things. But again, there's absolutely nothing wrong with ETFs. And I think I have the time to dedicate to this. An ETF would be very well for, well, depending on the strategy, actually, because if I wanted for capital preservation, I would say VT ETF is good for that. where I just basically set it and quite literally forget it. Set it and forget it. Geographical concentration, the superior one, biased, I know, but the SPY or VOO, anything with doing with the SP 500, VTI, but that's biased, geographically biased. So take that with a grain of salt. America, that. Well, I'm Venezuelan by birth, so I am very highly appreciative of the United States. I'll say that, extremely highly appreciative. So I'm the classical immigrant that grew up in the United States and grew up to highly appreciate the United States. So I'll just say that. Anyways, can you do other thoughts on interest rate hikes? Fed 50 basis point hikes. Well, they're planning and guiding for a 50 basis point hike again. I think Federal Chairman Jerome Powell stated as such. But the question is, are they going to do two of them? They could be more aggressive. Remember, even if you're Snyder pilled, I say this a lot, even if you're Snyder pilled, you still believe that the Federal Reserve does affect sentiment. Now, if borrowing costs do rise, if rates, let's say rates to borrow, and let me be very specific on that. Banks, when you go to the bank, you try to borrow and the rate is higher than it was before. If that is occurring, then we have a little bit of a problem with regarding liquidity, because that's going to have drastic effects across the board. Remember that something like Brookfield Asset Management, let me see how that stock's doing, but let me explain myself. And I talked about this briefly. Why did I sell Brookfield, even though I love the company? So I sold Brookfield at around 50 something, 54, $55 a share, around there. And why is it I sold it there? I mean, we'll take a look at the price action more recently. So you see, it had a high of 60, 61. Wow. But in November is when I was started talking about this liquidity crunch. And I didn't time this one exactly when I was discovering, because I was still more like understanding it than anything. My real action came in December. But Brookfield Asset Management was a stock that is a company that benefits from competing against fixed income instruments like bonds. So pension funds will go to Brookfield Asset Management and say, hey, Brookfield Asset Management, here's my money. Can you help me invest this for my pension? Because yields right now are terrible. And then Brookfield's like, yeah, sure thing. I'll buy all these other types of assets, and we'll do it through an instrument that we also own. And also you guys, by the way, can own, because it's a publicly traded entities, and they own all these publicly traded entities. Brookfield Asset Management owns a big portion. Another big portion is owned by their investors. And then also another big portion is owned by public investors, such as you and I, who can buy into those stocks. So then Brookfield does that. And but in essence, they compete against those fixed income securities, such as bonds, right? So if the yields come down, a lot more money might flow into Brookfield Asset Management's pockets, and then they can generate fees off of that, etc. Now, if yields go up, that increases the competition, so to speak, for something like Brookfield Asset Management. And arguably, some people might also say the same thing similar to REITs. But yeah, I'd be more concerned about the REIT's borrowing costs and hoping that, cap rates fluctuate in tandem with that, because if this is going to be really bad for REITs, really bad for REITs. And I'm not saying this is going to happen, but this is a scenario that could be really bad. So if rates rise or the borrowing costs rise, but cap rates don't necessarily rise, that's going to be bad, because then it'll be self-fixing, because REITs will go through a time in the short to medium term where they're basically going to suffer. They're not going to be acquiring as many properties as before. That's going to further then drive down demand for those same properties, and that should then raise the cap rates further. So then that kind of self-fixes the problem, but you still go through that medium short-term awkward phase, because real estate's a little bit slower moving than stocks. So little quick thought there, but do you see the Nasdaq now behaving like it did in 2000, taking many years to recover to its highs? Oh, I have no idea. It depends on how bad this blow up is. Because in the 2000s, remember, we had a lot of stocks that weren't making even revenue. There are companies that I have covered that don't make any revenue, and strangely enough, have very strong followings. I even had a comment today from that stock. I won't call out the person or the video, but yeah. Oh, there we go. So another question about REITs. What do you think of the share dilution that REITs do? Well, that's normal, because REITs, and I hope that enough people have seen my lives to know that this is a fix that I have to do because of Jeremy. All right, I'm calling him out by name. Jeremy caused this problem that a lot of people out there investing, and I got comments in some videos, and usually it's always the same comment, and I know where it came from because he worded it this way. When a company is profitable, they say it doesn't need to dilute. No, if you think that, get that out of your mind. Get that out of your mind. And I know it came from him because he worded it that way. And I still get comments here and there. There's nothing wrong with those people because those people were newer to the markets and they heard it from their first teacher. And their first teacher had the best impression on them. And that was that individual. But when a company is profitable doesn't mean that they're not going to dilute. It's the management's job to lower the cost of capital as much as possible. So where I work, we try to lower the cost of capital as much as possible. We're not publicly traded, so we don't issue shares like that, but we try to lower it as much as possible so that we can take on more projects. We can take on more investments. And then that's our hurdle rate, right? So then when you're looking at a company like a REIT has the option to take on debt or to issue shares. If we simplify the answer and say, I can borrow money at 6%, but my stock is yielding, let's say, you can think of this in two ways. I'll just use dividend yields to simplify it. Let's take an example. Let's pick one. Realty income, this is considered to be like a high quality REIT. Okay, it is a high quality REIT, but look, the dividend yield is 4.4%. We're going to simplify this example. So let's say I can borrow at 6% and I issue shares at a cost of 4.4%. Which one am I going to do, right? If I find a property that has, let's say, a cap rate of 7%, borrow at 6% or issue shares at 4.4, which one's going to have the lower cost of capital? Issuing shares. So I'm probably going to issue much more shares, and that's still accretive to you, even though I diluted you, because the delta, the difference between the 4.4% and that 7%, which is 2.6%, that 2.6% actually is increasing the funds from operation. So that's basically what REITs focus on entirely. And then vice versa, it's actually better for a REIT when their stock price is richly priced because they can acquire cheaper and cheaper costs of capital, right? So their cost of capital gets lowered a lot, and then more deals are available to them. They can afford, the keyword afford, to find properties with lower and lower cap rates. But this changes if they go through a downturn and their stock price is going down. It actually can be like a cascading effect on the REIT where they can't really find good deals because their cost of capital is getting so high. And remember that the borrowing rate also has a lot to do with the stock price too. Well, that's how it kind of works because the lender is going to have to take everything into account. So, that they perceive a lot of risk, it will influence, your bond yield. So it's more like they're correlated more than anything else. I'll say that it's not cause, but there's a correlation there. So you gotta think about that too. So if a REIT gets into trouble, it can get into quite a lot of trouble quite fast. Okay. You also have like REITs, for example, that had to do whole restructurings, and I'll give you an example. So CXW got me into a huge side topic, but whatever. I think it provides value. So CXW and GEO Group, they're very controversial REITs. They own private prisons. So both of these companies are no longer REITs. I believe GEO is no longer REIT. I know for sure Core Civic is no longer REIT. It was a REIT. And the thing is, they actually lost all their funding capability from borrowing from the bond market. They couldn't really borrow, not bond market. They couldn't borrow money from banks, right? Banks wouldn't lend to them because of political reasons. And so on top of that, and I'll highlight this, let me go down to the 5-year. On top of that, their stock price was going down and down and down. And their cost to issue shares was growing because their dividend yield was growing. And remember that REITs must pay 90% of their taxable income to the shareholder. So they have to do this, right? So they stopped issuing the dividend at one point. They cut the dividend. And they stated that they're going to transition to a C Corp because a C Corp allows them to retain the cash flows from the business and then fund future projects. But as a REIT, it makes it very difficult because a REIT is a pass-through entity. So also, side note, if you ever hear anyone complain about the tax structure of a REIT, saying it's unfair that they don't pay any taxes, slap them across the face and explain to them the difference between a non-pass-through entity and a pass-through entity. So a pass-through entity, the taxes burden falls upon you, the owner. So it doesn't fall under the corporation, it just goes right to you, hence pass-through entity. And then you pay the tax. So the tax is still being paid. So people like to stop at the explanation, and this is my, my problem oftentimes with CNBC. Like they just stop the explanation and they don't go further. So like with a REIT, the REIT makes its money, the money goes through the entity, and it goes to you, and then the taxes are paid, unless you have it in a tax advantage account. But it goes to you, and then it gets paid. All right. So then someone is paying the taxes. It's not like no taxes being paid. And also want to mention this. They usually cite that the REIT index has outperformed the regular stock market index over long periods of time. Well, that is because the regular stock market index has taxes in it, right? Because when corporations generate income, they pay tax. So that's a cut from the government that the government basically takes out of the profits. But the REIT index obviously doesn't have the tax taken into effect because it's filled with a bunch of tax-through entities. So mathematically speaking, of course it's going to outperform because it has greater ability to compound because the tax isn't being taken into effect, right? They're pass-through entities. And on top of that, real estate has been pretty good to own over the past 40-ish years. So yeah, just a bunch of side commentary there. Answering your question, summary of everything. REITs, it's normal for them to issue shares. They go through, there's a thought process you have to take when you think about share issuance. Echoes from above. Hey, Echoes, nice live stream. It's good to see legit YouTubers give clarity instead of pumping the same YouTube stocks. And on that note, guys, you should buy Tattooed Chef, TTCF. They're a fantastic company, growing 50+% per year. Trust me on that. And they're going to 10x in 10 years. I'm just kidding. That's a joke. All right. So Fabio, be killing the chat. Love the interaction. I love you, random citizen. That's a reference to an old movie now. Would it be possible for you to create content on how market liquidity behaves when interest rate goes up, along with the Fed reducing balance sheet? Oh, well, I think I just accidentally answered your question in a previous comment regarding, if the cost to borrow rises, and that in essence reduces, for example, the ability for people to borrow to buy assets. In the case of let's say real estate, if it costs me more to borrow money to buy a home, some people will be priced out of the market, so to speak, because interest rates, and I explained this, actually, I'm spoiling it, but one of the core concepts I do talk about in the first lesson video in the Pay What You Want course is what are interest rates and what you have to think about them conceptually when regarding to economics and money. It's basically the cost of money, right? Interest rates are the cost of money. So as the cost of getting money goes up, well, how does that affect the present markets? So, it's equivalent to me saying, you go to the store with $10, but now you're going to go to the store with $5. Obviously, now you're going to buy less. So if the cost to borrow money goes up, the quantity demanded for loans, if you remember economics, price goes up, quantity demanded, not demand, quantity demanded goes down, then you have a little bit of a problem there with regarding some particular assets. That includes real estate, that includes stocks. And we talked about, remember the January video when we went over the leverage rates, talking also a little bit about the velocity at which leverage went up kind of drastically in 2021, liquidity boom, liquidity crunch. Yeah, all that comes into effect, especially when you have all that leverage in the system, how that kind of unwinds itself. So yes. Big topic, quick one. Do you think Fed will stop the balance sheet street contractions once they reach? I have zero idea. That would be a question I would have to kidnap. I'm just kidding. No kidnapping involved of Federal Reserve officials. Not at all. But something that you would have to ask them directly, and hopefully they answer your question directly. Adding to, yes, I am. Even though I've only added to Netflix this week, I'm looking, and I'll just tell you right now. Oh, insider information. Front load the stock, pump it now. No, is Warner Bros. Discovery. I probably will be buying more. Do you pay attention a lot to European companies? I do pay attention to some European companies, not all European companies. But yes, some European companies. I have some European companies that are on my wish, my super wish to own. So I would say that LVMH is one I wish I could own. Nestle is one I wish I could own. Juvedan, which is a Swiss company, I wish I could own too. Its competitors, International Flavors and Fragrances. My wife laughs at me every time I say that name. I don't know why it's funny to her, but she thinks the name is hilarious. But it's the competitor, the American variant of Juvedan. Yeah, those are some European companies off the top of my head that I think are excellent. SMBC ROIC 40,000 share buyback increasing paid in capital. I don't remember that one, but probably. I don't know how many share buybacks they're doing. I think I think that company was doing a stupid amount of share buybacks. I'd have to take a look to answer that question, but I'll do an update video on SMBR if it goes down a lot. Do you think the Russian-Ukrainian war will lead to similar issues in the market, U.S. and Europe? The last Greece was about to default. I mean, it could. For sure, it is. It's causing a shakeup in the commodities market. I mean, but that's kind of obvious. That's not really giving anything. But I don't really know if it will have that kind of effects. Do you think stocks? Do you think bank stocks are overvalued now? Oh, yeah. I'm so happy you brought that up. I will be adding one bank stock. Probably like either this week or next week, but most likely this week. Probably tomorrow in the open, and I'll be nibbling on it. And I'll be rebuilding the position because it used to be a position. It used to be my largest bank holding. So now it's going to rejoin, and it's a bank I love. I've mentioned it all the time. My hint is that Buffett loves it too. We agree on it. Aflac Insurance Company. What do you think about it at these prices? Aflac. I mean, what is it? Is it still going up though? Insurance companies, they went through a period of just absolute hatred. They have what I call, and I call this. So if anyone else says it, they just watch my videos and they're trying to take credit. I'm kidding. But in all seriousness, I call it industry scarring. I mean, yeah, that's a broad term, so anyone can come up with that. But industry scarring, insurance companies, particularly not Aflac per se, but a lot of insurance companies went through an industry scarring because of '08. Aflac didn't. Yeah, you see, Aflac did not. Car insurance companies did not go through that. Health insurance companies did not go through that. In particular, it was like life insurance companies, stuff like MetLife, Prudential, stuff like that. They've always traded at discount valuations after the fact, after that event. All right, but Aflac, I'd have to take a look at it. Insurance companies, solid business model, to be honest. In a rising rate environment, you'd probably want to own these things. But everything has a little bit of nuance. Every company is going to be a little different. You have to pay attention to how their liabilities are affected by events. Okay, so I'll just say that Aflac was flat, only rewarded shares. Okay, so you see, without me looking at it, if I think that, yeah, there might be better options, and there's always better options, but yeah. Extremely unlikely crypto will go to zero, but it'll probably go lower though for sure. I mean, if the liquidity crunch continues, yeah, Bitcoin, don't be surprised if it does. But yeah, I don't know. Personal question: what's your exposure to equity in terms of percent and cash at this time? Last time I checked, my personal exposure to equities, as far as I'm only going to compare cash and equities. I'm going to leave out real estate because it's going to be a lot easier for me to do that. But equities, I think right now is closer to 60-ish. Because last time someone asked this question, I don't remember the guy's username. And I won't. Actually, what am I doing? I wouldn't even name drop them. But the last time I was asked this question, I was closer to, I think, the 50-ish%. So now I'm closer to like the 60-ish percentile. No, actually, no. I'm actually now above 60-ish%. But then I always come with the reminder that, I also have other things in my life that I have to worry about, such as like, purchasing real estate. So I have to have some cash around. So it's kind of like where it's not the same thing, but it's kind of like how when where people quote Buffett has all this cash laying around, he has it because he wants his company to be a fortress balance sheet, and he has all these liabilities from the insurance side. So it's not technically all that cash is available to invest. Similar thing to me, but not for the same reasons. I don't have an insurance company. So for me, it's because I'm kind of wanting it there, ready to go. However, like I just said earlier in this live stream, if the market like screams to me, like buy me, okay, I will allocate more capital to the markets in a meaningful way. But yeah, get the wife on here. She doesn't want to be on here, unfortunately. So my if my wife was doing a live stream, I guarantee you there'd be 1,000 people watching this, because that's just how the internet is. I don't know if she's outperforming me. I'll actually take a look and I'll answer that. But with thoughts on investing in bonds in the next 1 to 2 years, allocation 5 to 6% of your portfolio. I mean, that would probably reduce volatility if you hold to maturity, for sure. Because if you hold to maturity, at least in nominal terms, you're going to be fine. But if you don't hold to maturity, if you actually hold for sale, and basically meaning that your plan is to sell the bonds at any particular time, then be careful, because rates can continue to rise. And if they do, you're going to actually lose value in those bonds. Be very careful. But if you hold to maturity, in nominal terms, you're not going to lose any money in nominal terms if they pay it back. Okay. Heed my words there. SoFi might be yeah, maybe. I don't know. I have no idea if he'll go below 100. Sorry, 10K, 100K. What about Parity City? Oh, Party City. Party City. What happened to Party City? Is that? I don't even know that was a stock. What the heck? Stock. Yeah, you see, double stock. Let's go to stock. Party City stock. What the heck? It's a company. What the heck? Down 84% in a year. This is priced for bankruptcy. Don't even have to look at that. Cigarette butt investing is very difficult. I want to tell you right now, everyone, if you think that you're a cigarette butt investor, I would heed caution on all of you. Cigarette butt investing is very, very difficult, but very lucrative, but very difficult. You're more likely than not going to lose money. Okay. But I'm not saying this is a cigarette butt. It just like appears to me. So yeah. What are your thoughts on dollar currency index skyrocketing? Well, in times of uncertainty, people flock to the dollar. And the world has a lot of uncertainty last time I checked. So then there's a lot of money flowing into the dollar system because the United States is looked as a bastion of safety right now at the present moment, and other countries are not. So like I would just briefly mention, the European members of the Discord were, or at least some of them were providing very interesting data points showing that there is like a decent crisis brewing in Europe. And I think they're going to have a harder force or harder brunt than the United States should something happen. And I think the money flows are showing that. So yeah, because remember, when we look at value of currencies relative to other currencies, that's the key word, relative to other currencies. So yeah. Are you looking for a house? If you were to pick today, would you get a fix or variable rate? No, I'd get fixed. I like the certainty and planning around certainty. So especially when I take on debt, I want fixed. I want a fixed rate. I don't care if I pay more today. That's fine. And then if the rates ever go down, I can always refinance. And I always pick a house that I can easily pay off. So not like I'm saying like the mortgage, and that's like getting into philosophy on personal finance, but easier said than done. I know some people it's harder than others, but I pick a home that I enjoy, a safe area, location's good, and I can easily make the payments where I don't have to stress, and I can continuously contribute to my asset portfolio, whether it be publicly traded stocks or rental properties. So then, the place I live in has to be like that. All right. But anyways, to adjust your price target for the stocks, the capital function of Fed rate, a capital rate for the company. Do you adjust your stock price target for stocks capital as a function of Fed rate or cost of capital for that company? It has, for me, it's not so much. I think you're talking about the risk-free rate versus CAPM. I'd say that I would not. I don't really like to use CAPM for these for like an investment in a particular company. I use it at work for internal projects to dictate whether or not an internal project is worthwhile or not. Because that's the cost of capital measured against as a hurdle rate for that project. But I hope that answers that question. This is an article found on Google. Nothing South Park Index. Oh, that's hilarious. I want to actually take a look at it. In 2008, Lehman Brothers brought down the markets. Do you think crypto will play a role in 2022? That role in 2022. I don't know how much money really is in crypto, but heck, it could. But the thing is, it's not that money is destroyed. So, okay, so here's the difference. Money will be destroyed in the borrowing and inability to pay back. That's what people need to understand. So with crypto, that money was not destroyed. the value was destroyed. And if money was borrowed against it, that's how you can destroy some money right there. But let's say hypothetically, I have $1 million and I buy some crypto for $1 million and it goes to $1 billion and I'm the only buyer. Let's keep this example simple. And then it goes down to zero. Someone might say $1 billion was destroyed. No. $1 million was destroyed. No. $0 were destroyed because I gave someone $1 million for their Bitcoin. They now have $1 million. No money was destroyed. Now let's change the example. I borrow $1 million. I buy Bitcoin with $1 million. It goes to $1 billion, then it goes to zero. I don't pay back my loan because it went to zero and I have no money. I declare bankruptcy. $1 million was destroyed. Okay, in that example, in that same example, because in that case, the borrowed money, and we're getting to like the banking system, but what you have to know is just the borrowing. I still gave someone $1 million, but then I borrowed that $1 million from the bank, and then the bank, we're expanding the money supply at that point because the bank probably lent it at some point by quite a bit. Basically, I destroyed money. And so I'm oversimplifying the example, but you get the picture. When I'd have to pay attention to like how much leverage is in the crypto system. I don't think it's that much. Someone might correct me and say there's a lot, and I'll be like, oh gosh, then yeah. But if there's not that much leverage in the system, then it shouldn't be that much of a spread. The thing is, remember Lehman and all that was a lot of money that was on leverage. Think about mortgages. That's a lot of leverage in the system. That's a lot of money that was just poofed, gone. Imagine just deleting billions upon billions upon billions upon billions of dollars out of nowhere, all of a sudden. All these liabilities just still being there, but the assets just boom, gone. And in this case, the asset is borrowed money. This is money that actually was destroyed. So yeah, that's my comment on that. Hurdle my turtle. Julius, fun laugh. Nano Dimensions is a buy or sell due to no ARK. If ARK holds any credibility lately, I don't know what to say, but I'd say that, remember, ARK is a sales pitch at the end of the day on innovation and blah, blah, blah. That already ruins any possibility of me working there. Or maybe Kathy would like to value someone who's a counter voice on her team. And then I can play that role. Kathy would. You can pay me a good amount. You pay me she pays me like, I don't know. Hit me up with an offer, Kathy would, if you're watching, and I'll see what's up. But yeah. I'll sell out if the price is right. All right. So really income or PLD, which REIT would you prefer? Okay. So I think the thing is Prologis is right now in a sector that probably was overbuilt in some areas. For example, where I live, not really. There's still so much room to expand. Population growth is like crazy. But Prologis, I'd say, well, you know what? I'd probably say right now than Prologis, but they're both great. You basically gave me two great companies, so it's not fair. It's hard. I'd rather own KO over similarly priced REIT. Yeah, you see, but like with Coca-Cola, you have sound of mind, and Coca-Cola is a company that cannot be destroyed. Coca-Cola is immortal. As for now, there you go. I just said for now, so that doesn't make it immortal. But yeah, no, and I'd probably be in agreement with you. I'd rather own a company like akin to Coca-Cola over just REITs or real estate, because I'd be like that. A Coca-Cola can move around. A REIT can't really move around. So a REIT is highly exposed to geographical political risk. High exposure. A lot of people don't think about it that way, but insane, right? Okay, so in my opinion, social media unites Jeremy and Kevin and a lot of others will at least catch on investigation. Yeah, maybe. Hi, Fabio. I wonder, when you speak about growth capex and capex, isn't Opex capex and what you call growth capex just normal capex? Or have I missed or understood something? Thanks in advance. No. When you see the line item where they are doing, well, a company might separate it for you. You're absolutely right, Alex. Actually, some companies, and if they do that, take that information and apply it, because you actually do want to do that. But I'm talking about when you're looking at the financial statements and you see the line items or capital expenditures, and it's just Capex by scope together, then they don't separate it, then, you're going to have to do that. But the quick and dirty way of doing it, and some people have also kind of in previous live streams talked about this, you can take the depreciation of that given year, and this is the dirty way of doing it, and you can then apply it as kind of like a maintenance Capex. But yeah, you want to sometimes be careful with that because, depending on the timing of it. You should review Jack Duffley's portfolio. So many people's portfolios. But yeah, Joseph Carlson's coming up really soon, Julius. I remember went back when you requested that. You know who did not get any votes, because I guess no one gave it absolute dog poop about him, is Stockmo. Stockmo was on the vote and he got like no votes. So if you guys wanted him to be reviewed, you got to go vote. Got to go vote. I sound like a politician now. Got to get out there and vote. What is the highest weighted commodity of Rio Tinto? Also, REITs are beginning. I don't know the answer to that off the top of my head. I actually forgot because I've actually lowered my exposure to Rio Tinto, so my focus hasn't been on that. I think it was it copper or iron? It was one of those. Yeah, Rio Tinto. I have more BHP in my mind, but also REITs are beginning to look more attractive after recent pullback. Yeah, and you see that was a point I talked about, and I was a little bit wrong for a while, and I was like, what the heck? The liquidity crunch, they're still going up, because my thesis was like banks would go down and REITs would go down a lot, and REITs like did not go down. So I was like, what the heck? All right, whatever. But now they're going down, so I'm like, yeah, proven right. One of it appeals to me because the concern is increasing discretionary spending. Yeah, but like, will it be forever? It's just like I don't think it's gonna be forever. I'd rather just accumulate now. I think they're gonna get through it. I think they're well capitalized enough. But yeah. Yeah, so like that's like my thoughts on that. That's just some of my thoughts on that. I invest for, I know it's cliche at this point because so many people overuse this, but right there. Oh, we have Austin. Austin's in the chat. Austin's in the chat. I'll get to you, Austin. Austin's my really good friend, by the way, for those of you who don't remember him. He's a very good friend of mine. So I just doxed you, Austin. So SMBR already down. Everything Money did their 8-pillar analysis a few months ago. Oh, you guys are talking. I skipped over accidentally. DBX earnings were pretty good. Are you planning on to add to it? Yeah. Dropbox, I think, is on the acquisition categorization. So yeah, I do like Dropbox. VTX, is that Voxture? Voxture is interesting. Yeah, Voxture is interesting. They do a lot of their business is more or less revolved around appraisals. So yeah, Voxture's a little small Canadian company. Very interesting. I might do a video on them. It's just they're really small. SMBR is already way down. EM did 8 pillars on them a few months ago and kind of forgot to look at the balance sheet. Somehow Paul sold puts and without even looking on the long-term debt. Oh, short-term debt. Yeah, you remember the live stream I did live with Sleep Number? I remember now. I just took a quick glance at it and immediately found there was debt. And I remember their video because it was actually brought up to me, Sleep Number, because he did buy Sleep Number. And yeah, so moral of the story, don't do analysis like Everything Money. Don't do analysis like Everything Money. That is, yeah, don't do that. Don't do that. That's irresponsible. Very irresponsible. If with your own money. I mean, geez. Yeah, they did miss that. And it was the short-term debt. When we actually took a look at short-term debt, they had some debt. And then they were saying like it has no debt. And they were stating that for their viewers, and it's not true, etc. Okay. So cigarette butt investing entails huge opportunity costs, especially in this market where so many quality businesses are on sale. Yes, Dark Knight. That's exactly true. So, Buffett even says, and I'm, Buffett's overquoted at this point, but I agree with him that you want to own great companies at fair prices. And if you can own great companies at great prices, heck, yeah, man, come on, give it to me. And, there's a sense of almost like finesse where it's like, it's so great because it's such an easy, not easy, but it's such a, I don't know how to put it, but there's something that it's an unquantifiable value to have a company that's great in so many different categories that you can also sleep well at night. And there's like a relaxation factor that you can't really put a number to. All right. So what is the difference between Capex and Opex in the line items and salaries? Do the Capex, Opex after the cash from operations? Oh, hold on. I got to break down this question. What is the difference between Capex? Well, operating expense. Oh, yeah. So no, operating expenses is not, no. Do not confuse those two. Good thing we brought that up. And I think I just saw my mind or my eyes just went straight to Austin's comment, because Austin's also an account. We have a lot of accountants in here. And you see, there you go. We have a lot of accountants answering your questions. So I'll actually just go over those briefly, but I'm just reading through this and highlighting them. Austin says Capex is capital expenditure and is found in the statement of cash flows represented by maintenance expenses. Yep. See, he's already explaining it perfectly and also explaining it well here and also well here. Yeah. So you got these two are both accountants. They're kind of nailing it on the head here. Oh, you're in Swiss. Okay, cool. So, it's well, not Switzerland, by the way. I meant, yeah, Swedish. There's like a yogurt company. I forgot the name of it that I got to remember. It's like Carlson something. And they do like yogurt, like bacteria for yogurts. I forget the name of the company, but it's great. Oh, wow. Okay. So maybe, but like doing what? Doing what? 300K for doing what? Just a thought. I'd pop in and say hello. Oh yeah, hello, Austin. Yes, yes, but that'd be interesting, I guess, because I mean it's close by. Work from home, maybe. Yeah, nobody cares about stock mo. No, nobody cares about stock mo. I guess no one, because no one voted on it. I did cover this company a long time ago now with Austin, and yeah, way down, way down. But yeah, because we did say it was like priced for some crazy stuff, like, and it was quite risky when we took a look at it. Yeah, Cortel Retail. Yeah, I mean, I remember this. Yeah, Jesus, man. I mean, everyone can go back and watch that video. Remember other things we stated. Yeah, I'll do an update. Yeah, why not? Investing in data center REITs, DLR is good. EQIX is the big boy. I think that sector has a lot of tailwinds, and pretty good sector within the REIT space. Can you review and provide comments on the content created by Oswas, Professor of Finance and Stern School of Business? I mean, sure, that'd be like reaction videos. But yeah, I can think about doing that, because I think he can provide. He probably, based on these titles you gave, he probably provides good value. You can just lie and rip people off to work at ARC. Yeah, just I'll be like, just telling Kathy Wood, just like, yeah, the stock's a buy. Just like, yes, man. Her. No, I'm just kidding. No, if Kathy Wood actually hired me, I'd be honest to her and I'd tell her, consider these risks, please. And then I'd be the employee that she never listens to. And yeah, that would probably be my role there. Yeah, because like being paid 300K to analyze these companies. Yeah, heck yeah. But you know what would happen? I would have to probably stop doing YouTube, because I'd be doing analysis for a publicly traded ETF, and the restrictions on that would be probably quite drastic, especially on what I personally can invest in. And for me, that's a no-go. So the pay would actually have to be higher, in my opinion, because if you really think about it over long periods of time, that heavy restriction, probably not worth it. And it'd be hilarious if their retirement plan is just ARC. Like you can only own ARC funds in their 401ks. That'd be absolutely funny. But yeah. Yes, you just actually mentioned this. Saudi Aramco is now the number one company by market cap. Apple number two. I'd rather own Apple between the two, because Apple, I think, is more future proof in their business lines than something like Saudi Aramco, as well as the security risk of government intervention with Saudi Aramco. Basically, have to huge, massive, owner in that company. So, Do you think strongman will try to beat you up if you get more subs? No, I think we're all in like this community together where we have all these agreed upon philosophies, and I think it's like it's going to be its own ecosystem where we all don't believe in the principle of screwing people, and then we think that people can be successful without screwing people. So heck, I think that, for example, I was thinking about you know doing something along the lines with my pay what you want course, and uh strongman collaboration. I'm just mentioning that for the first time, but I have nothing really like planned there yet. All right, we got a super chat. I'm grifting. No, I'm kidding. Love your channel. I'm a fellow finance major and YouTuber. Oh, Juan Valdez. All right. So everyone, here's Juan Valdez. So if you're doing YouTube content and you're a finance major, you're already a step ahead of the big boys because they have none of that. So finance major. So you're already learning. If you're currently a finance major, you're already learning about discounted cash flows and all the fun jazz. So I really appreciate that. Thank you so much for the super chat, and I'll be sure to check out your channel as well, Juan Valdez. All right, so Kathy Wood, Jen Paxi, to show I'm not biased. I don't know what the context of this comment is. To show I'm not biased. Or just a comment about reacting to some videos. Are you interested in any renewable energy companies at the moment? No, but Next Era Energy would be like the company that's like the big boy in that, and a company kind of like Berkshire Hathaway. They have a huge renewable business within them. Yeah, I think Robinhood will exist 10 years from now. They're really big, but maybe not the same size. But yeah, Costa Marine Time. Haven't seen them yet, but I'm having to wrap up, guys, because I actually got to go eat. All right, so I'm gonna have to wrap up. But yes, oh yes, the communication is being made between the accountants. Good. Coming from a non-accounting finance background, Professor Dama's valuations videos make my head spin. Okay, so then maybe I can try to break those down. I always wanted to ask you guys, and this is a serious question. What do you guys think of me doing a series where I read Warren Buffett's letters to shareholders and then commenting on it? Hey, Chris, have a good night. Do you guys think that would provide any form of value or not so much? Okay, it's normal to hate investing, but still investing. No, I don't think so. I don't know. Maybe. What do you think about the OSTK share conversion? Is OSTKO the one from their platform? I think that's the one from their platform, but yeah, CCJ, the green energy not being covered at all needs. I think we all have to use more nuclear energy. Yes, I'm in agreement with you philosophically. All right, so I'm getting a lot of yeses for that. A series on Buffett's letters would be awesome. That's a book that compiles ones I believe. Yes, so I'll be. That's the book I was gonna actually read out. No, I know which book it is. I actually have it. So yes, okay, so a lot of yeses. So I'm gonna do that. I'm gonna create like a series, and it'll be just a playlist someone could listen to. And I'm just going to be basically narrating it. So you'll hear my beautiful voice going, oh, and so the Buffett, blah, 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 or whatever he says. All right, first time I have caught you live. All the best from Scotland. Hey, welcome. Series on Warren Buffett letters. Okay, so yes, a lot of series. All right, guys. So I'm going to wrap it up there. I have to go eat and then get back to work. And on that note, I will see you guys next time. I'm going to be on the Discord, of course. If you guys have questions to ask me, I can try to respond there. But yeah, if you're not part of the Discord community, you can join the Discord community to at least have your voice heard on the voting when new stocks come up. And just so everyone understands, WSM and Open will be in on the list for voting. All right, guys. I will see you guys on the next one. Bye.